Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They are the Dividend-Growth stock portfolio, which was started in 2022 and now has an annual return of 19.57%, and our high yield stock portfolio, which is an annual return of 22.53% per year. The high yield portfolio was started in 2023, and on the chart I've also included their benchmarks for comparison in blue. Now, I recently started putting the list of dividend growth stocks that we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link to the Substack newsletter in the video description. Again, it's totally free to sign up for. I'm just trying out Substack to see what it's like as a platform. And since I'm brand new to Substack, the newsletter is nothing fancy right now, but should get better as I learn the platform over time. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year as outlined in red, and now has an annualized return of 23.58%. It's one of our newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where we make additional investments on the first trading day of each week. So in effect, all three of the portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our Wide-Moat and capital light portfolios, which are also beating the S&P 500, as well as a potential sector rotation strategy. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos, so you can go online to read more about them if you like less frequent trading. They can be found on beatthestockmarket.com. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 103 holdings, our high yield stock portfolio has 38 holdings, and our tech stock portfolio has 26 holdings. Now here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite, since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform, as I mentioned on the previous slide. So far, Substack is easy to use, and it's turning out to be more fun than I expected. I can put a lot of quick notes on there in real time during the week, as well as my weekly post about what stocks we're buying and the dividend growth portfolio. You can find the list of dividend growth stocks we're buying on the first trading day of each week either on Substack or on my website, beatthestockmarket.com. You can find most of the strategies on my website, beatthestockmarket.com, but if you can't afford it, each week for free I've been detailing the dividend stocks we've been buying in these YouTube videos, I should say every other week now. And then I feature the tech stock portfolio on the next week, and as well as the Wide-Moat strategy and capital light strategy. Now, I found that Substack has a notes feature, which are free for anyone to read, and last week I posted a few notes, one of which included the capital light stocks that we bought for our capital light strategy, and one note about the Wide-Moat stocks that we buy. If you are interested in that, sign up for free on the Substack and follow me. Again, this is all free on Substack. And so in the green box here, I've added a note that those three strategies are newer, and therefore the average investment has been held for less than a year. You can see a breakout of this green box down here. Here's the average number of days the stocks have been held so far. Over time, that will grow. For example, the capital light strategy is by far the newest, as it was started in February of this year. As you can see in the bottom table, the average investment in that strategy has only been held for 65.4 days and has a return of 8.28% on average during those 65.4 days. The annualized return of 56.01% should be taken with a grain of salt. All it means is if a stock's price increases 8.28% every 65.4 days, you'd get an annual return of 56.01%. It's probably not going to keep up that high of a return, but we'll see what happens in the future. So just be aware that the annual returns of these three newer portfolios jump up and down a lot, but will settle down over time. Now this slide is showing the portfolio value over time of our original portfolio, our Dividend-Growth stock portfolio, which invests almost exclusively in Dividend-Growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $3,100 after 180 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week, especially when it gets to be earnings season. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. I consider a high-yield dividend-paying stock to be high threes and above. Now the tan line in this chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks or bonds didn't do well at all. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November 2023. I'll update our tech stock portfolio in next week's video, which we started in late April of 2024 and has been the best performing of our main portfolios over that time. And for those that have been asking, all three of the portfolios are now on my website, beatthestockmarket.com. We post the stocks we're buying in real time on Mondays, when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. So if you're new to my channel, I'm an accounting professor that teaches accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly equivalent of $50 a month, into those 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. Now, before we get into which stocks we bought last week, a lot of people have been asking me about my favorite books about investing. My two favorite books were the basis of the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value stock screen and the Consumer Staples stock screens. I update the stock screens once a month. So what is a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them to narrow it down even further. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. Save yourself some money. It's a much shorter book than What Works on Wall Street. I've put the link in the 2 books in the description of the video in case you want to check them out. Also, check to see if your library has them. Save yourself some money. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETFs, ticker symbol SCHD. SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, the average investment in our Dividend-Growth classroom stock portfolio has an annual return of 19.57%. If we'd instead invested the same exact amounts into SCHD in the same days, the portfolio's return would only be 6.44%. Our high-yield portfolio is also outperforming SCHD. Now, obviously, there's no guarantee that our portfolios will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our 2 dividend-paying classroom stock portfolios, as well as some of our other strategies too. I also prefer our actively managed stock portfolio strategies rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps, and that's not a good thing. So this slide shows our best performing stocks for our original portfolio, the Dividend-Growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. Broadcom is still in first place and now has a 346.7% total return. Evercore, an investment bank, is in second place with a 252.9% total return. It's in yellow, which again means it's been sold. The fastest risers that are still in our portfolios are Bank of New York Mellon, which has more than doubled in 20 months, Goldman Sachs, which is up over 106% in 26 months, and Perdoceo Education up 97% in 22 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now, the two worst performers are Atcor and Vestas Corporation. Fortunately, I only made one investment in each of those two stocks instead of the usual about 7 investments or so. That's about the average we make in these stocks. But both of those stocks are down over 50%. Those two stocks are categorized as under the radar dividend payers. You can see some of those over here in the strategy column. Now, only 8% of the investments so far have been invested in these under the radar dividend paying companies, which are defined as companies that have recently started paying a dividend. These under the radar dividend paying stocks tend to be riskier because they are usually smaller companies like Atcor and Vestas. But studies have shown they historically beat the market averages by a significant amount. Now, the other 92% of our investments made in this portfolio were made in the category called Dividend-Growth, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. Despite some of the huge gains in the under-the-radar dividend payers, like Crane Holdings and F&G Annuities, both more than doubling, and then ReposiTrak almost doubling, we've not done quite as well with the under-the-radar dividend payers as we have with the dividend-growth stocks. So I foresee us cutting back our investments in the under-the-radar dividend payers in the future. Now, you might be better at analyzing these really tiny companies like F&G Annuities and ReposiTrak, and then the two crappy ones, Vestas and Atcor, and maybe you can do better than we are. So here is a slide. On this slide, it's showing our best performing dividend growth stocks this past week. It does not include dividends. The best performers were EOG Resources, which is an energy company. Now, recently, there's been a conflict started in the Middle East, Iran and Israel, and so oil prices have shot up. So EOG is being helped by the oil prices being higher, as well as Chevron down here with a 4.1%. So some of the other higher gainers this week were KLA Corp, one of my favorite chip companies, 7.4%, Eli Lilly 6.5%, LyondellBasell Industries 6.3%, and then we've got some others at 5% to 3%. And this slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. The best performers this past week were EOG Resources again. It's in both portfolios, Novo Nordisk, and then we got some others here too. So here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. So on this slide, we're showing the stocks we sold this week for our 2 dividend stock portfolios. So we didn't sell anything for the dividend growth, but we did sell Gilead Sciences for our high yield portfolio. We sold it because it appeared to be fairly valued, and our 4-way rating for it, and the four ratings are valuation and business outlook, quality, grade for recent dividend growth and current yield, and then lastly, grade for dividends growth potential. That 4-way rating had fallen to the bottom 29% of companies. Based on its initial purchase for this portfolio, we sold the company for an approximate total return of 30%, held for 6.6 months. That's an annualized return of about 60.9%. Now, this is the second time we've made a round-trip trade in Gilead. A round-trip trade just means we bought it and then we later sold it. The first time we bought and sold the company resulted in a total return of 29.9% in 128 days on average, which is a 110% annualized return. And that time, fortunately, we made 16 weekly investments into it, so it really helped the return of our portfolio. Now let's talk about the dividend growth stocks we bought last week. I posted these rankings to our website, beatthestockmarket.com, as well as Substack last Monday, and then we purchased the top 10 stocks. So again, on this slide, my ratings are the top 20, but we only buy the first top 10. We show the extra 10 because people were interested in seeing a longer list. So we purchased the first 10 stocks on the list that are not in yellow. None of them are yellow this week, but if they were in yellow, that means the stock comprises 4% or more of the portfolio, which in that case, we don't buy any more of it because we don't want the portfolio to get top heavy. Now remember, we use many criteria to filter stocks, and if a stock is hovering near the required level of a certain metric, the stock can make the list one week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock for this strategy if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. A stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Now, just because a stock doesn't make the ranking does not necessarily mean we're going to sell it right away. Each week when we list the stocks we're investing in, we also will alert you about any stock we're selling from that portfolio. So again, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine that weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. Now, the table in this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends. And our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. And remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock on the next feed, and the high yield stocks in the next few slides. This week I purchased over $3,000 of the stocks from this list for my dividend growth strategy. So I am using this a lot more on my own. It's not just the $12.50 that we start investing every week. So on this slide, I want to show the same 20 stocks, but this time we're looking at their quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for about 92% of our purchases. The other 8% or so, so far have been invested in smaller under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are small companies, but studies have shown they historically beat the market averages by a significant amount. Risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, But that's not the way it usually works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. So don't chase high yields. Now let's talk about our quality rating. One of the components is moats, a measure of competitive advantage. One advantage of companies with the best moats is if they pay dividends, they're more likely to increase dividends even during an economic shock when compared to when compared to companies with no moat. Now, so on this slide, Morningstar shows there are three categories of moats. On top, we have the companies with wide moats, which are considered the best. The slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies, remember those were the best competitive advantages, were able to raise their dividends despite many companies being in financial trouble during that 3-year period. Only 18% or so cut their dividends. Now, for companies with no moats, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or a narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than that. But if you want a simple one metric way to look for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5.5% to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. So once again, we had several dividend increases for our dividend portfolios. This week, W.R. Berkley, EOG Resources, and Lowe's. So W.R. Berkley announced it will increase its dividend by 12.5%, and they will pay another special dividend. The company has paid a special dividend 6 times in the last 2 years. Berkley has been holding in our Dividend-Growth stock portfolio for less than a year and so far has provided a total return of 41.8%. This is the 24th consecutive year of annual dividend increases for the insurance company. Over the last 7 years, Berkley's dividend has grown about 10% per year. The company currently has a 7.4% payout ratio, which is extremely low. And that means it has plenty of room to increase dividends in the future while also continuing to pay special dividends if it so chooses. So W.R. Berkley underwrites an array of commercial insurance and reinsurance products on a global basis. Sounds like a boring company, but the dividends growth definitely is not boring. Now, EOG Resources is an energy company, and they recently announced they will raise its dividend once again, this time by 4.6%. The company has a 7-year dividend growth rate of 27.7%, which is crazy high, and has paid a special dividend 8 times in the last 5 years. EOG currently has a 3.68% dividend yield and a 34.6% payout ratio. The company is a holding in 2 of our portfolios, our Dividend-Growth stock portfolio and our high-yield stock portfolio. And also this week, we had Lowe's companies announcing it will increase its dividend by 4.3%. Lowe's is a recent addition to both our Dividend-Growth stock portfolio and our Capital Light portfolio, which we'll talk about next week. Or you can go back to last week's video and watch that to learn more about our Capital Light portfolio. So Lowe's is a dividend king, meaning it has increased its dividend for at least 50 consecutive years. Now, over the last 10 years, the company's dividend has grown 18.6% per year, and the company currently has a 38% payout ratio. So of the last 22 dividend increases for the portfolio, they've averaged 7.1% increase. Here's a look at the 10 stocks that make up the largest portion of our Dividend-Growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Now, aggressive investors might not want to limit their investment into any one stock, but I'm a conservative investor. Therefore, we temporarily stop investing in a company for these portfolios anyway, if they make up more than 4% of our portfolio. I should say for the dividend growth. This leads to a less risky, more diversified portfolio. Now, it's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst possible time. Now, our portfolio holdings are 80 dividend growth stocks and 23 under-the-radar dividend-paying stocks. The under-the-radar dividend-paying stocks tend to be riskier because they're usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. So those under-the-radar dividend payers are defined as companies that have recently started paying a dividend. So a dividend grower, on the other hand, is someone that has a long history of increasing their dividends. So the other 92% of our investments made in this portfolio have been made in those dividend growth stocks, which means they're high-quality stocks with a great track record of increasing their dividend payouts to investors. Now, despite some of the huge gains in the under-the-radar dividend payers like Crane Holdings, 132% gain in 18 months, and F&G Annuities, 117% gain in 12 months, this category of stocks, and again, we're talking about the under-the-radar dividend payers, has not done nearly as well for us as the proven dividend grower. So I foresee us cutting back our investments in the under-the-radar dividend payers in the future. Now, 80 dividend growers might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet. But the spreadsheet did take about 2 years to create. It took a long time to create, and it's kind of complicated to learn how to use. Once you learn how to use it, it's pretty easy. Now, by comparison, SCHD, the popular dividend ETF that we compare our performance to, it currently also has 103 holdings. That's just a coincidence, though. I think we've been as high as maybe 107, 108 holdings. Recently, I trimmed back a little bit, and I have a feeling we're going to trim a materials company this Monday, but we'll see. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and are asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts in a separate account. Now, the portfolio as a whole has an annual return of 22.53% so far. Surprisingly higher than our dividend growth portfolio, which is not what I predicted. Currently, the high yields portfolio's dividend yield, if you waited until today to buy all the stocks, would be 4.2%. Compared to our dividend growth portfolio, the companies in this portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks high and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 4.88%. Now, 2 strategies are being implemented in this portfolio, as you see in the next couple slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features dividends or stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and some dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 15.28% and has been held for an average of 234.7 days so far, which is an annualized rate of 24.77% using Excel's rate function. Now let's talk about the high yield dividend paying stocks we bought last Tuesday. Well, I can't remember. Was last Tuesday a holiday? Anyway, first trading day of the week. I posted these rankings to our website, beatthestockmarket.com, and then we purchased all 8 stocks. And because the high yield stock portfolio currently has less than 1% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income, with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance as great a chance to grow their distribution yields as fast as a company like Microsoft or Broadcom. There's always a trade-off, and again, don't chase high yields. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. As I said in the previous slide, strategy 1 emphasizes a high dividend yield over dividend growth, that's in red. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1, 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, a lot of times there's some overlap. As you can see, Comcast, Merck, and PepsiCo are in both ratings, with UPS and EOG being different. So there's always going to be some overlap. So the 4 high yield stocks we bought last week while implementing strategy 1 are Comcast, Merck, Pepsi, and UPS. And for strategy 2, we bought Comcast, Merck, EOG Resources, and Pepsi. Now here's a look at last week's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will usually be lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields but a greater potential for excellent future growth in those dividend payouts. So if you want growth in your dividends, you should focus on the dividend growth portfolio. If you want higher yields, I would recommend starting with these stocks. Now, this slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the latest month increased 44.8% over the same month a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. I would say about 90% of the money I invest in are invested in stocks that pay a dividend. So why do I prefer investing in stocks that pay a dividend? The first reason is, according to a Hartford study, over the past 51 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.2% per year, but for non-dividend-paying stocks, average return has been much lower at 4.31%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return on average. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see in the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend stocks only invest in dividend-paying stocks that have recently increased their dividends. Now, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first ever dividends, called initiators, grew to $2.6 million. That same amount invested into non-dividend paying stocks only grew to $1.2 million, a difference of 116.7%. And when compared to the S&P 500, which, remember, contains both non-dividend paying companies and companies that do pay a dividend, the dividend growers and initiators performed 62.5% better. So not only do dividend-paying stocks historically have a higher return on average than stocks that do not pay a dividend, dividend-paying stocks also historically outperform the S&P 500. They also have less volatility on average. That means it's going to go way up and way down, much less. So you're going to get a smoother ride, which causes less panic. And they perform better than non-dividend paying stocks in down markets, also called bear markets, by about 1 to 2% per month. And that's not per year. I mean, it would still be good if it was per year, but this is per month. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge quickly. But dividend-paying stocks tend to hold up much better in down markets than non-dividend-paying stocks. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first one is Broadcom. I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well in the future. And if not, that's why we've constructed a diversified portfolio. This is the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for an investment newsletter I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low of 0.83%, meaning for every $100 you invested in the stock, you would only receive 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has increased the dividend to the point where the yield based on original investment is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well in the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields and costs that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you can have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, the amount is $63,350. Those amounts usually increase each year as the standard deduction increases and tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did I choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck or $50 a month? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the dividend growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% per year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invests an additional 35 cents each week, for a total of $12.09 per week instead of $11.74. Now, for a classroom dividend growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't nearly as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 each Monday. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Number 1, each week on Monday I post the top 20 dividend growth stocks on beatthestockmarket.com and now Substack. The list is also shown on this video. Of those 20, I buy 10 different dividend-paying stocks ranked 1 through 10. Now, of those 10 stocks, on average, the stocks ranked 1 through 5 outperform the stocks ranked 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only stocks ranked 1 through 5. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 66.7%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Or you can invest in all 10 top-rated stocks, but invest more of the stocks ranked 1 through 5 than the stocks ranked 6 through 10. So there's a lot of possible options. So number 2, you could try not limiting the individual portfolio holdings to 4% of the portfolio's value. So normally, for the dividend growth portfolio, if a stock's allocation of the portfolio is 4% or greater, in other words, it's grown to 4% or greater of the whole total value of the portfolio, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all your expenses, plus generate extra income for vacation, travels, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio, they might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking as mentioned in bullet point 1. So far, not limiting individual stock position to 4% of the portfolio would have improved annual returns by 73.9%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities 119% gain in 12 months and Repositrax 97% gain in the same time frame, on average, they have not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well as large stocks in recent years. Like the previous strategies, This method reduces portfolio diversification. And number 4, you can potentially sell when a stock is fairly valued, even if dividend and quality metrics are excellent. So we don't sell often in the portfolio and tend to only sell if the company cuts the dividend or the stock appears to be overvalued or the company's dividend quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued but the dividend and quality metrics are still good, like as in they're still in the top 50%, we usually will not sell a stock just because it's fairly valued. But if you have your own valuation methodology and it signals that a stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding onto fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about a couple of ways to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says you need to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. Now, when I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 each week. But I switched from every other week to weekly because I found the process to be fun, plus it gives us more diversification. So if one doesn't mind less diversification in the portfolio, option 1 is to invest every other week or even monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. In this case, you'd skip the under the radar dividend payers. Over time, some of these quality stocks will turn out to be clunkers. That's inevitable, but they will just become very small parts of your portfolio as you let your winners run. So that's it for this week. In the comments, let me know if you have any questions, and also let me what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can see me, you can reach me, I should say, YouTube, obviously, as well as our website, beatthestockmarket.com, now on Substack, LinkedIn, and Twitter. So I'll talk to you next week with another portfolio update, most likely about our tech stock portfolio, wide-moat strategy, capital light strategy, and a potential sector rotation strategy. See ya!